Are bonds poised to break out? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Bob Elliott, the CIO of Unlimited Funds and author of the Non-Consensus Substack. Hi, Bob. It's great to have you on.
Hey, thanks so much for having me. It's great to join you on this new platform.
Yes, that's right. And we are live, as I said. So, welcome to everybody who's joining us live on Substack and on YouTube. As always, drop your questions and comments in, and we'll get to as many as we can. So, looked like it was we were gearing up to have a pretty quiet, boring day, and then all of a sudden, the headlines started flying about Trump planning to fire Fed Chief Jay Powell. And then the market stocks sold off, and then they bounced back, and we seemed like we kind of didn't go anywhere, but there was a lot of churn on the back of that. Um, what's your sense of what's happening there? Just political noise, or do you think that there's a real risk that we could see some changes at the Fed?
Well, I mean, it certainly, I think, was the shortest taco trade of the year, as far as I can tell. I mean, and we've had some short taco trades, but this one takes the cake. I think it was 45 minutes before it was recanted. Um, I, you know, I look. Look, we have to recognize that that there is, a non-zero possibility that the administration will make an effort to engage in meaningful political influence on the Fed, including firing the chairman. I think one of the things that's a bit of a struggle on that dimension is, Jay Powell's one vote on a board of 12 members, plus the rotating or with the rotating governors. And so if if President Trump is really committed to ensuring that he gets his way as far as monetary policy goes, he's going to have to do a lot more than just fire Trump or fire Powell from the chairman's seat in order to get what he needs. I mean, he's probably going to have to fire all seven governors, and maybe even put in place some heads of various of the regional banks in order to achieve his goals. And I think the question is, does he have the political fortitude to be able to go through that whole process to get his goal, or is this mostly just political maneuvering, knowing that his policies are very growth negative, the economy is slowing, and he's going to need somebody to blame it on ahead of the midterms.
Yeah, that's a great point. We've already got some great questions coming in, so I'm going to jump to them right away. And Kelly and Associates asks, "Hey Bob, however the Fed chair ends up being replaced or whatever ends up happening with the Fed, with a lower dollar and lower bond yields, how much less treasuries will foreigners purchase?" Good question.
Yeah, it's a good question. I think it's easy to forget that foreign private sector investors, meaning like European and Japanese pension funds, endowments, et cetera, have been some of the biggest buyers of Treasury duration. In fiscal year 2024, actually, foreign private investors bought 100% of the duration issuance of the U.S. Think about that. That's pretty incredible in terms of how much the U.S. government financing was reliant on foreigners. It's been a little bit less this year, but not that much less. And so I think the real question is whether or not those investors who are pretty radically overweight U.S. bonds and U.S. assets in general and the U.S. dollar, what they intend to do. And my guess is we're going to see a slow but sure recognition that being massively overweight U.S. assets, either on the equity side or the bond side, doesn't make sense. Investment mandates will be shifted. And more likely than not, really absent sort of a more extreme event, we're probably transitioning from a period where, we had 15 years of basically straight up dollar strength. We're probably transitioning to a period of, 15 years of dollar weakness relative to other developed currencies. And that's, any one day, you probably won't notice it. But when we wake up 15 years from now and the dollar is down 50% relative to other foreign currencies, it will have had a meaningful impact on the returns that most investors experience.
Yeah, we've got some other good questions coming in. But before we do that, I just want to ask, since we're talking about bonds and rates here, what is and what the Fed should do. What's your view of what's happening with the US economy? Because the Fed's posture is sort of like, it's mixed. We're concerned. We want to wait until we get a clearer picture. We had decent jobs number. You can point to the inflation numbers weren't terrible this week, but they're not dropping like a stone. You can point to evidence on either side of weakness and of strength. What do you see happening under the hood for the U.S. economy?
Well, I think from the Fed's perspective, it's almost pretty simple, which is the Fed looks at core PCE inflation and the unemployment rate. And if you just basically any model, any Taylor rule model, or the dozen or so derivatives of Taylor rule would say at a 4.1% unemployment rate that's been stable for a year, and core PCE that's at roughly 3%, give or take, the Fed should leave interest rates where they are right now. And so in that sense, a Fed that's focused on being data driven and responding to the data that they see should do nothing. And what they've done nothing. I wish I could do nothing for months on end and be employed, but hey, but I guess at the Fed you can do that. No, and that set of choices is decided that is consistent with the data. There's just no getting around it. Part of the reason why that is because the slowing of labor supply has been so extreme that even though we've had a big slowing of labor demand, the unemployment rate hasn't deteriorated. I think when you look at the economy as a whole, the conditions are sort of a lot weaker than the stance being presented by the Fed. A simple example is, household consumption, real PCE has been negative in 2025. Now, the U.S. economy is a consumer economy, and it is not going to be strong in an environment with zero or slightly negative real PCE growth, right? And there's lots of other things going on in the economy, but ultimately, the ultimate demand in the economy comes down to the consumer, and the consumer is in a tough position. I've talked a lot about how the best lens here is to consider what I call an income-driven expansion, which is a non-consensus view in terms of what's actually driving things. And what that means is, income, meaning wage income that households earn, is going to be the predominant driver of their spending. And when we look at that, we see a slowing of labor markets, around zero labor growth, meaning around zero jobs growth, if you triangulate across all the different measures. And then you see softening labor markets that are leading to a wage growth number of about 3% nominal. So if you have zero job growth, 3% nominal wage growth per worker, that's 3% nominal income growth in an environment where we have 3% inflation, which leads to 0% real growth in demand. And that's how the numbers work. And that is considerably weaker than what is currently priced into either the stock market or the path of interest rates ahead.
Yeah. Couple of comments, questions. Paul, political fortitude or not, the markets would absolutely spiral if Trump fired Powell. Do we think that's still true, given the fact that there's so many rumors and false starts? I mean, by the time he actually got around to it, it's probably been priced in and out of the market a bunch of times. Are they getting a little bit sort of deaf to this sort of threat? Do you think that would cause an issue?
I think the primary lever where it would cause an issue is with how the dollar, and particularly the dollar relative to gold, would trade. And Bitcoin's a little more uncertain because it's kind of half a contra currency and half a risky asset. But that's predominantly where you're going to see the effect. You're going to see it probably a little bit in bond prices, but one of the challenges is if the whole goal is to install a what I call a political hack Fed, their goal is to basically bring down interest rates across the economy. They certainly the Fed has all the tools in the world to bring interest rates down if that's the desire, both on the short end and on the long end, and they would probably do that. I mean, just remember that the country with the largest government debt load amongst the major developed economies has the lowest interest rates. So it's not like it's an impossibility in terms of being able to bring down your rates. It just comes down to whether you print enough money to bring down the rates. The lever that's really going to feel the effect is in the currency. And that's both in the dollar crosses, but probably even more so against gold. And so, that's why I think the vast majority of investors are totally underweight gold in their portfolios. They're up to their eyeballs in bonds and don't have basically any gold. And this is, if there was a time to be holding gold in your portfolio, like now, like now is the time as a hedge. And we saw that today. Gold was the best performer. Bonds sold off a little bit. Gold was great, right? Responded directly to it. Stocks sold off. So like, even though it might have been a stimulative, it's effectively stimulative if you have a political hack Fed. That's, there's also a risk premium element. So ultimately the big winner, the big diversifying asset in this whole dynamic is gold.
Yeah. Boris asking, saying, looking forward to this session. Thanks, Boris. My question to Bob. The Bank of America Fund Manager Survey shows a sell signal as fund managers' cash levels are all quite low. What do you think of this signal?
Yeah, the signal itself, if you look back through time, it's not that great a trading signal in and of itself. But I think the sort of broad idea of like, has this rally gotten a bit over its skis? I think is it's sort of captured in the concepts that are being represented in that Bank of America Fund survey. And so, I primarily trade from a macro perspective. My time horizon is kind of in the 3 to 6 month range and connected to the real economy. But I've been around this business long enough to know, just eyeball market and see when it's trading soggy. And that's kind of what the feel that the market has had in the last couple of, really the last couple of weeks. Like, it's been very hard to get this equity market to move meaningfully higher after sort of the short-term euphoria after the big beautiful bill. And I think that's reflective of the fact that, like most investors who have leverageability, they're pretty long stocks or are not interested in buying anymore.
You tweeted something about this getting close to the season of disappointment, I think you called it. What do you mean by that?
When I think about what the biggest driver of particularly equities over time, the most reliable driver from a macro perspective, like in a 6-12 month time frame, is basically how growth comes in relative to expectations. That's it. If you tell me what expectations are, you tell me what growth ends up being, like, I can basically predict, the equity market, as if it was that easy. But anyway, it's a good framework to have. And so, when I look at that, basically equities at all-time highs, you've got out year, like double-digit earnings growth, very, very strong expectations. And then at the same time, you look at, the real economy, and we're pretty close to putting up a zero when it comes to end demand. Maybe it's not in the second quarter, maybe it's in the third quarter, but and that's without a lot of the effect of tariffs and immigration policies, really coming into the market quite yet. And so that's the season of disappointment. Like, everyone is bulled up on the U.S. economy and U.S. stocks with high expectations, and I think they're going to be disappointed.
Yeah. So Fab saying major divergence between the ISM under 50 and sky high S&P. Will equities mean revert or ISM start rising to mitigate? Sounds like you think the S&P needs to go down to reflect what the reality in the economy.
Yeah, and I think part of the way that you answer that question is you look at what are the fundamental drivers of economic conditions to see whether they're poised for acceleration. And when I look at, as I said, this framework of the income-driven expansion, I don't see a lot of indications that we're likely to see an acceleration in either hiring or wages. Now, wage growth might stabilize a little bit here and not be as soft as it normally would be with such low job growth because of the low labor supply. But 3% nominal income growth is not going to get it done in this economy with 0% payroll growth. And so you look at that picture, so how do you get it? So you basically either have to have job growth pick up, which there's not a lot of indications, even like secondary indications like hiring intentions or consumers' views on their job stability are all very, very weak. Or you have to have consumers dissave. Why are they going to dissave? They're going to dissave if there's essentially in response to a significant rise in asset prices. And I think that's one of the challenges is, a lot of folks are like picking, well, on April 8th to today, we're up 25%, which first of all, just in and of itself is like an extraordinary rally over that time frame, which calls into question sort of its durability. But the reality is like stocks have basically been flat for, 9 months now. House prices are going down. This is very different than where we were in say 23 and 24, where stocks were going up meaningfully. Like we've had an extended period of mediocre equity returns. And as a result, I just don't see a lot of possibility that households are going to run out and dissave in this sort of environment.
Yeah. So if stocks look toppy, we know the dollar's in a long-term downtrend. What does that mean? What do you see happening with bonds? We were in a period in that shakeout in April where we saw Treasury stocks and the dollar all moving lower, which was of concern to people. Are we in another one of those periods where that's possible, or do you see bonds benefiting here?
Yeah, I think bonds relative to cash are positioned to do pretty well, and I know it's a real it's a non-consensus view to say, hey, maybe y'all should be looking at bonds. But in an environment where there is likely to be a significant growth slowdown, or whether the reality is there has already been a significant growth slowdown, not yet reflected in markets. Bonds are the go-to trade. I think probably from my perspective, one of the challenges with them is you can have that sort of aggregate monetary sucking out that could happen if there's sort of loss of faith in the U.S. financial system, let's say. And so there's sort of, I think, two important ways to mitigate that. One, I actually like holding gold with bonds because you get, today's a perfect example, like bonds were a little soft, but gold more than made up for bonds when you're looking at those positions. And then number two, holding those positions, those long positions relative to stocks, because part of the story, what's the cure for high bond yields is high bond yields. Like that's the classic thing. And we've seen that happen a couple times over the course of the last couple of years. Bond yields like kind of bump up to 5%, say on a 10-year. And then stocks start to feel the hit. And so that actually makes for a much sort of better hedged trade is actually going long bonds and gold relative to stocks, because if we have a circumstance where bond yields rise, meaning bonds sell off, it'll probably at this point have more an effect on the stocks than it will on the bonds.
Yeah. MK asking, changes to the bank SLR impact on treasuries, ?
Yeah, the change in the SLR is more of a benefit for distribution of dividends and income in the current time frame than it is really about buying treasuries. Basically, no bank is restricted based on liquidity ratios or otherwise to be buying bonds. The reason why they're not buying bonds is to take on wholesale financing to buy bonds in a flat yield curve environment is just like not a good financial decision. So I think part of the story, to sort of contrast my view with sort of the bond doomer crowd, is like, look, if what happens is the short, economic conditions are weak, the Fed eases, or maybe there's a political hack Fed and it aggressively eases. Part of the way the bonds are going to get financed is long duration bonds are going to get financed is from the fact that the yield curve will steepen, and that steepening of the yield curve will cause banks and others to basically borrow cash and buy bonds. Like if you go back to the 50s, the returns of bonds relative to cash were actually fine because the yield curve was steep. People levered up. If you did, banks in particular levered up, put a lot of their balance sheet, took deposits, bought bonds, wrote a 200 basis point yield curve, and that was a pretty good deal for them. And so we'd probably get that same effect in this sort of scenario, whether it be from slow growth or a hack Fed. The story is first, though, you've got to get that sort of weakening set of conditions, and then that's going to create the bid on bonds. And it's really an economic decision for most banks right now. It's really not a regulatory constraint that they have right now.
So you don't buy into this camp that says bonds are just uninvestable. Given the sort of long-term devaluation of the US dollar we're looking at, that they're just, it's criminal. They're just robbing you of your, because there's a whole group that think that it's a bond vigilantes are back and the US fiscal house is in such bad order that they don't care what Trump wants. You're just going to see we're in a higher interest rate environment just because you've got to compensate people for taking on what, is no longer maybe that sort of best in class in the world.
Yeah, I think you want to think about what are the returns of bond returns in what terms? That's what you want to think about. So as a simple example, the path that you outline, which is essentially a steep yield curve, high term premium, is actually a very good time to buy bonds relative to cash. Because if the dollar is getting devalued, right, cash is getting devalued and bonds are getting devalued, but you're earning essentially a good yield on bonds relative to cash. And so, so the idea of buying levered bonds in an environment where there's, a elevated risk premium, it's actually a good idea. But that doesn't mean that bonds will deliver bonds like outright, cash bonds outright. Like if you bought TLT, it doesn't mean you're going to get a good real return on TLT if you buy it outright, because through this process, you'll probably have a depreciation. You essentially have to have a depreciation of US bonds relative to hard assets, because it's the only way to deal with the indebtedness problem. And so that's why, why I'd say if you're thinking about sort of a strategic portfolio right now, you've got to get some gold in there, because gold in many ways is the hedge to the bad bond real return over time.
Yeah. Yeah, great point. And Cosmo commenting, no bonds for me. Thank you very much. I'd rather hold stable coins. So one of the first comments in the chat was, can Bob please touch on the recent ETH and Bitcoin run up? Thank you.
Well, what I'd say, I'm a casual observer of Bitcoin and largely ignorant about Ether. So, take that for what it's worth from a macro person's perspective. I look at Bitcoin mostly as a way to understand what are trying to diagnose essentially what are the primary macroeconomic drivers behind Bitcoin. And what I'd say is I continue to see that predominantly what you're seeing are risky asset positions, speculative positions. And I think mostly what you're seeing through the course of the year confirms that, in the sense of during the April turmoil, Bitcoin went down a lot. Bitcoin then recovered basically at all-time highs. Interestingly enough, right, recovering in a way that actually looked lagged to the S&P 500. And so, look, if you're looking for and in basically very little of that, maybe like in a single day time frame or a couple day time frame, did Bitcoin exhibit contra currency properties. And so maybe maybe it'll be like digital gold or at some point, but none of the empirics suggest that it's trading like that. And so, look, it could be it can be a fine asset if people want a more highly levered, effectively risky asset position to have on in their book. But recognize you're not getting something unique. You're getting more volatility of risky assets more than anything.
Yeah, so the whole store of value is not quite there for you yet, it sounds like. If you're going to do that,
and I
you
think
just do gold.
If you want a contra currency, like gold is continuing empirically to demonstrate that set of returns that are consistent with that, and to be honest, has 5,000 years of doing that. So, that's I'm not excluding Bitcoin for any reason other than the empirics are not compelling.
Hmm. So you have 4 ETFs now, is that right? And
That's right.
what are you is it reflective of this bond gold versus stocks, or tell me a little bit about how you're thinking about that, and if you're just straight on treasuries, or if you're thinking about, what's the mix there?
Yeah. So our 4 ETFs are what we do is we replicate how hedge funds are positioned. So we have technology that allows us to understand how they're positioned in real time. And then we put that into an ETF wrapper. And one of the great things about that is because we're using technology to figure out their positions, we can do it at a much lower fee point and much better liquidity than investing directly in hedge funds. And hedge funds through time have done actually quite a good job generating returns. The real challenge is that the fees are too damn high, which means that the managers take all the alpha for themselves, and investors don't see any of it. So we're doing it at a much lower fee point. It's much more compelling outcome for most investors. And I like to, in answer to your question, I think actually global macro, one of our products, HFGM, which is the global macro strategy, I think is probably one of the most telling. I'm drawn to it as a macro investor. And I think it's kind of it's interesting when you look at how macro managers are positioned today. What you see is that they are long bonds as their largest risk position,
Hmm.
and long gold. And when it comes to sort of risky assets or pro growth assets, they hold a significant position in high yield debt and foreign stocks relative to pretty modest holdings in U.S. stocks. And so, they're looking at those other assets, not U.S., not all in on U.S. large caps in order to express pro growth positions. And then notably, they are also short the dollar relative to most developed currencies. So I think that portfolio, it's a portfolio that has been delivering very good returns with low beta to the S&P 500 over the last couple of months. And I think it's a pretty compelling portfolio, indicative of some of the themes we just talked about.
Yeah. Is it catching up though for missing? A lot of hedge funds miss you just mentioned they were sort of underexposed to U.S. stocks. Did they miss that bounce from April that you just talked about before, how extraordinary it was? The sort of narrative out there is that institutionals missed it and retail's the one who stepped in and bought, and they were right.
Yeah, I think that story is more true among the equity managers that really were focused on really played defensive positioning after the April turmoil. Macro managers have largely been long risky assets in general over the course of the last couple of months, and have gotten a lot of that bounce and delivered pretty strong returns.
J asked, where do you think the money leaving the U.S. will go? To its own, are we talking about back to wherever these fund managers, pension funds are, if they're European, back to Europe, kind of repatriating back home, or is there another part of the world that you see receiving the funds? So I guess you have to first say, do you think it's rest of the world outperforming U.S. equities from an equity lens, and then where do those flows go?
Yeah, I think most of them come back to the sort of normal home bias that investors have. At one point last year, the U.S. was getting essentially like 70 or 75 cents of every incremental dollar that went into global financial assets, and that is crazy. That's just that's a crazy overweight for global investors. And so even getting 65 cents of every dollar flowing into financial assets would actually be detrimental to U.S. asset prices. It's important to keep that in mind of every incremental, let alone reversing the positions. And so when I talk to big global institutional asset managers, they're basically like, ooh, that was quite a run in U.S. assets. Maybe we should take a breather and basically, go back to sort of our long-term, meaning like over decades, sort of closer to that benchmark in terms of positioning, which almost always has more home bias in it than a global benchmark does, and that shift is enough to be supportive to foreign stocks and foreign equity markets relative to the U.S. I think also probably worth, if it wasn't for, like, if we didn't have this tariff thing and the firing Jerome Powell and the cutting off all immigration, like what we would be talking about would be the fact that we have one of the largest global coordinated monetary and fiscal easings that we've seen ever when it comes to a period of fine growth, right? Like global growth right now is 3%. It's fine. Global growth is totally fine, and nonetheless we have a massive easing, fiscal and monetary easing, and that is very supportive to equity in particular. And the thing is, it's just not supportive to the U.S. because the U.S. has a frozen Fed and a federal government that's engaged in massive negative growth policies.
It sounds like no matter what, just on a rebalancing, coming back to the norm, the U.S. equity market is vulnerable to a pretty sizable correction. Like even if everything's great, even if you're super positive, it just based on getting that number down from 75 cents for every dollar, you're looking at you're looking at selling pressure.
Yeah, I mean, we have had, we reached a point, and there's all sorts of different charts that illustrated this point, but like we reached a point of the world being overweight U.S. assets, unlike we've never seen. That we didn't see during the tech boom. We didn't see it in the post-war period. Like we've never seen it. And now we're reversing that extreme trend. And these sorts of things happen all the time. Like I can remember when, like the US was left for dead in 2010 and the world was massively underweight US assets, and, the dollar was cheap, and that teed up a great run for US assets in the post GFC period for an extended period of time. What we're seeing now is kind of the reversal of that. And that's a very normal set of shifts that you see in terms of secular capital flows. And I think that the challenge is, so many folks sort of started in this business after the financial crisis. So you kind of only saw the dollar going up and U.S. assets outperforming. And it's like the only thing that they've ever seen. And some of us are old enough to remember like when emerging markets outperformed and things like that, though we prefer not to admit it.
but that experience is coming in handy right now.
That's right. That's right.
Bob, such a pleasure to catch up with you. Thanks so much for coming on the show, and welcome to Substack. We're thrilled to have you there.
Yeah, thank you so much for having me. And this is a great environment.
It is. And great questions coming from all of you today. Thank you so much. You're on your A game. As all of you know who subscribe to both of us on Substack, we'll have a write-up on everything tomorrow. So you can, if you're crunched for time, you can look at that or share it with your friends. Bob will restack it as well so everyone can find it. And we will see you all again next week. We've got a special come in on Friday. As you know, we've been doing Summer Fridays, so we're not live, but Peter Brandt, great technician. He said to me, I don't know if you know Peter, Bob, he said he has made a living trading the markets for 50 something years, which is extraordinary. So hard to do. So he's just an absolute fount of wisdom. So we can't wait for him to share some of his thoughts on these charts. I think you'll like what you hear. So watch out for that on Friday. In the meantime, everybody, take care and good luck out there.